In this video, I want to show you guys exactly step by step how you could have capitalized on over a 16% gain in one trade, risking 2% of your account balance. Okay, so starting things off, number one, identify our higher time frame break of structure in order to get our directional bias. Okay, so number one, directional bias. Okay, where's the higher time frame? So in this example, we're looking at the 5-minute time frame. Okay, and let's mark on our break of structure. So clearly we've broke structure to the upside here. This is indicated by this strong bullish candle to the upside. This indicates that buyers are in control of this market. So break of structure to the upside, mark that on as a BOS. Once we've seen the break of structure, we can then go ahead and mark on our guarded low, which is our invalidation level. So we can mark on guarded low. We do not want to see price break below here. If price closes below our guarded low, that would invalidate our long bias and indicate that structure may be shifting to the downside, and therefore I do not want to be involved in that market. Okay, so it's important to have an invalidation level. Mark that on as a GL. Okay, number two is our point of interest. Our point of interest. And this is simply where are we looking to enter this market. It's that simple. And using smart money concepts, it's important to note that we only want to be entering the market out of extreme supply and demand areas. Okay, so our last down candle, so you can see from the open down to the low, this is our extreme demand. This is where the institutions are going to be looking to long this market. Okay, because if you imagine this, so imagine this from an institutional perspective, institutions sold into this market here in order to create this liquidity. They then entered heavily long positions in order to create this strong up move to the market. So us as traders, when price comes back into our extreme demand, what we're anticipating is that these institutions who stepped in long here, they're gonna enter more long positions, and they're also going to close the sell positions that they used to create this liquidity. So that ultimately is what will result in a bounce to the upside, a trend continuation. Okay, the institutions will exit the sell positions that they used for the liquidity, and we're anticipating that they'll enter more long positions in tandem to the positions that they already have open. Okay, so that's from the institutional perspective. Number three, once we've identified our POI, is a lower time frame structure shift out of our POI. Okay, lower time frame structure shift from POI. So we're looking for price. If and only if price comes back into our POI, then we can look for a long trade. Okay, so let's drop down to the lower time frame to show you guys exactly what we're looking for here. Let's move this across a bit so you can see clearly. Okay, so we're looking for price to come back into our POI, and that's exactly what price does. So price comes in, and now we need to look at structure on the lower time frame. Okay, so we can use a highlighter here, and let's mark this on in red to indicate the bearish market structure. So we have a low in the market, we have a lower high, followed by a lower low. Okay, so our entry schematic on the lower time frame, we want it to look like this. So we have a lower high, followed by a lower low. We then want to see a break to the upside, followed by a correction, and then we can look for a long trade. Okay, and the reason why this works is from a liquidity point of view is because all of the buyers who entered too early, their stop losses just got run. Okay, so we can mark here. So imagine imagine any buyers that entered this market too early. Their stop losses are just going to be below here. So we're going to run them stops to the downside, and then we want to see a shift in market structure. We want to see a break to the upside. Once we've run the retail stop losses, then we can look to enter safely here with, an anticipation of a trend continuation. Okay, so that's the entry schematic that we're looking for. So let's just pop over to the actual chart here, just to illustrate this to you guys. So we have a lower high in the market here. We can mark this on. We're looking for a break of that structure. You can see we've ran these stops to the downside. Okay, so from a retail perspective, anyone that's tried to get in this market early, so try to get in off this rejection, we've run their stops to the downside. Okay, and that creates the liquidity in order to move this market. So we've run their stops. We then see a strong break to the upside. After we've seen a strong break, we want to see a correction to around 50% of this down move here. So if we're looking at this over here, this is the down move here. So we want to see a 50% correction of that move. Okay, so we set a limit order just above there, and then we can look for the continuation. So the limit order is placed here, just above 50% of that down leg. Stop loss goes below the low, below our guarded low. Give it a little bit of room to breathe. There's no need to be greedy. Allow that trade to play out. Okay, give it a little bit of room to breathe. Target. Okay, let's look at targets. I'm just going to move this around a little bit to show you guys a clearer picture here. So target is going to be equal highs as a first TP. This is going to be, our equal high. Okay, we're going to reach for our equal high first off, and then we're going to look for further continuation to the upside. Because let's drop to the 5 minute and look at this on a closer basis here. So we've anticipated that we're expecting a pullback to around 50% of this down leg here. We then want to see our trade triggered in. You can see we're triggered there, and then price continues. Okay, so let's drop back to the lower time frame to show you guys what actually happened there. So we have the structure shift here, entry on 50% of that down leg there, entering, and then target first TPs, 2 risk to reward up to the high, and then we're looking for further continuation because we're looking to target all of this liquidity above these highs here. Okay, target all of that liquidity, and let's play this on the higher time frame here. Okay, so play this on. I know this is a bit of a mess, guys, but bear with you. These charts are pretty messy, but if you play this on here, you can see there price moved about a 5 risk to reward, and then ultimately continued through the London and NY session. So in regards to this trade, there was up to, you can see there, that's a 7 risk to reward. So if you risked 1% on this trade, if you risked 2% on this trade with a 7 risk to reward, that's up to a 14% gain that you could have had on this one trade. Okay, so that just shows the clear power of the strategy, and you have that potential for the trend continuation. Okay, so just to summarize here, what we have is number 1, a higher time frame break of structure. That's this here, higher time frame break of structure to the upside here. Number 2 is our POI, point of interest. That is this extreme demand here to where we're looking at taking a long trade. And then number 3 is our lower time frame structure shift. So when we drop down to the lower time frame here, you can see this here. This is the lower time frame structure shift right here. You can see we've broke that structure there, and then entry based on that. So that's the 3-step process in identifying and executing a trend continuation play using smart money concepts. Okay, I hope you guys like this video. Please like, comment, and subscribe, and I'll see you guys in the next one. Take care, guys.